The speculation today that the Federal Reserve of the United States might actually help the European Central Bank fight the region's debt crisis. Boston Federal Reserve President, as Ellen was saying, Eric Rosengren, he said that there could be coordinated action by central banks. That report came after the Bank of England warned that inaction on the crisis threatens the global economy. Joining me now with their perspectives, Danny Blanchflower, professor of economics at Dartmouth College. He's also a former member of the Bank of England's Monetary Policy Committee. And joining me in the studio, we have Vlad Milev, financial investment analyst at Metzler Payden. Good to have you with us, Vlad. Thank you. Danny Blanchflower, what do you make of this news coming out of the Bank of England saying that if Europe doesn't get its act together, it could have serious consequences for economic growth? Where have they been for the last year? I mean, this doesn't sound like a Brave New World headline.
I actually think it probably in some ways does. This all started in early October, where the bank, as a surprise move, actually ended up doing more QE, and then it had sort of apocalyptic language. I was looking at it again. It says tensions in the European economy, in bank funding markets, threaten the UK economy. So that was a surprise move. And then again today it brought out a forecast which basically said the QE that they've done is not enough to get us back to target. There's going to be more QE coming. But actually, Mervyn King talked about, but it all could be a lot worse than this. So in a sense, this is new information. Essentially, Mervyn King's been saying things changed since the end of August. So, and I think maybe the US has only started to understand that. This is really quite apocalyptic language. The growth forecast looks bad, but it's actually, many people already said today, too optimistic. So I would disagree with you a bit. I think this is, they've probably seen something, and what they've seen is pretty bad.
I love it when you disagree with me, Danny Blanchflower. You're much smarter. Apocalyptic language, Vlad Milev. The idea being that not only would the UK economy slow, but also economies, obviously, in Europe. You saw, for example, the yield on Austrian bonds, Belgian bonds, well as French bonds, all moving higher. We're not even going to talk about Spain, Italy, and Greece for a second. Vlad, what are you seeing?
Well, I think that the expectation of lower growth in Europe, that's not a surprise to us. I think that the market has been too optimistic over the Eurozone growth expectation. I think that a recession is definitely in the cards. We're going to see the first signs of that at the end of this quarter. And what really I've spent a lot of time worrying about is how that's going to affect my part of the markets, which is emerging Europe. And the effects are not going to be pretty.
Emerging Europe, all funded by European banks, particularly.
Yes, so there's a couple of different ways in which we can have a negative consequences on emerging Europe. The first one is, of course, through the banks. The banks are withdrawing. They're focused on survival. They're not focused on extending new credit into Hungary.
Yeah, this is not a customer story anymore. This is a survival of the fittest bank story.
Not at all. Short term also, there's a lot of exporters in this region that export to Germany and France and the rest of the Eurozone. Well, what's going to happen when Germany ekes a 0.3% growth next year? Guess what? The exporters are going to get hurt. And longer term, you also have a big structural issue. We used to invest in emerging Europe because it was converging with the European Union. What is the long-term story now? Convergence with the EU may actually be a negative.
Danny Blanchflower, come in on the topic of the cost of funding debt. Why is it seemingly so inexpensive for the United Kingdom to finance its government deficits compared to, let's say, Spain, Italy, Germany? Not Germany. Germany's better.
Well, I think there's a very simple explanation. The UK has its own central bank, it has its own exchange rate, and essentially the chances of default are essentially zero, given that the Bank of England can keep on printing money, can monetize the debt, and all the other countries that actually have their own exchange rate and their own central bank have done pretty well too. And you can use an example, Denmark, Sweden, Canada. So if you have a central bank, you can actually monetize the debt. The chances of default are slim to none. The comparisons between the US and the UK and Denmark and these other countries locked in monetary union is zippo, nothing. They are completely different, and the comparisons are not relevant, if you like. Bond yields are relatively low. There is a deficit reduction plan, but you got a central bank. Thank goodness they didn't join the euro.
All right, we're going to continue the conversation. I love it when he uses those technical terms like Zippo. Coming up, we've got more with Danny Blanchflower of Dartmouth College, more with Vlad Milev of Metzler Payden, and we're going to take a look at the battle between regional Fed presidents in the United States on just what to do to stimulate economic growth. Also, the man known as India's media mogul. We have Subhash Chandra. He's the chairman of Essel Group. He's going to be here to talk about the state of the media business in India. This is Taking Stock on Bloomberg. This is Taking Stock on Bloomberg. I'm Pimm Fox. All right, Europe's debt crisis continues to influence stock prices, overwhelming some positive U.S. economic reports and earnings news from the retailer Target. Let's find out more with my guests. We've got Danny Blanchflower, professor of economics at Dartmouth College. Also with us, Vlad Milev, financial investment analyst at Payden. And joining us now, Kate Warne, investment strategist at Edward Jones & Company. Kate, good to have you with us as part of the conversation. Do you think that the events in Europe are obscuring positive news in the United States for investors?
Absolutely. I think investors' attention is solely focused on what's going on in Europe, and investors really aren't paying nearly enough attention to the good news on the economy, and also the fact that we're basically through most of third quarter earnings. We've seen earnings grow at a rate of about 16% on a year-over-year basis for the S&P 500, and we've seen a lot of companies increase dividends. That typically is good news, and yet I don't think it's getting the appropriate attention from investors.
Vlad Milev, if I take a look at the Dow Jones Industrial Average, it's up just about 3% year to date. S&P 500 down by about 1.5%. That's much better than most emerging markets. If you take a look at what's going on in Brazil, it's carnage. It's down more than 15%. Where should people be putting money to take advantage of some of these sort of distractions that Kate describes?
Well, Pimm, I think you have to look at it from the perspective of as a longer-term investor, as somebody who wants to be exposed to the structurally sound stories around the world. Where would I go right now? Forget about the emerging and developed. I think that's a sort of a bygone era kind of definition. Let's look at the whole world. What are the sustainable stories and what are not? And if you make that distinction, I think you're going to find that emerging markets, if you use the definition, are going to come up on top. Now, the stock question is a bit more tricky, though, because I think a lot of what we've seen in stock markets in emerging markets has been the result of event risk in Europe. And until that's resolved, I can't see much of an upside. If I look around my area, my countries, I would say that Russia is an area that's looking very cheap, yet it can get cheaper. It can be 20% cheaper in a couple of months because we continue to get through the issues with Spain and Portugal and Greece and whoever's next. There's no way the Russian market's going to rally in that environment.
Danny Blanchard, come in on the topic of emerging markets, because don't most of the companies in emerging markets get funding from European banks? What's the likelihood that they're going to continue to lend to countries outside of Europe when they're worried about their own health?
Well, I think we are perhaps underestimating the scale of the shock that actually is coming on in Europe. I think the Bank of England talked about that worry today. The UK Treasury has been trying to think about the scale of an implosion in Europe, what it would do. I guess the right way to think, if it really does happen, banks stop lending, we see a really big recession in Europe. We're talking about something like 2007, 2008. Then it's going to be really hard to say the US economy is immune from that. Emerging markets are immune from that. My suspicion, it goes back to what happened in 2008. My suspicion is that the European Central Bank and the Fed and the Bank of England have seen some very serious things amongst banks. That's what happened in 2008. It wasn't made public. That's why they are panicking. It's hard then to think that the US or emerging markets are immune from that. I'm really very concerned now that this feels like October 2008, and you know what happened after that.
Kate Warne, if indeed you're an investor and you take Danny Blanchflower's description at face value, are there stocks, are there places in the investment world where you can go to perhaps avoid most of the downturn?
I don't know that you can avoid most of the downside, particularly if it's really a repeat of 2008. But I think there's some places where you're better off, and that's in the global companies that pay dividends and have a track record of paying dividends. Right. Partly because many of the non-financial companies didn't cut their dividends and they declined less. We actually think that's a good place to be regardless, because those companies have navigated through this kind of uncertainty before. And I would say the second thing is, while I would agree there's no place that's going to be immune from if Europe doesn't get its act together, what we also know is that everybody just had the experience of 2008. So we actually think that even if we begin to see some unraveling or some greater concerns in Europe, that you're actually going to see faster action on the part of the central banks in order to prevent something like 2008 happening again.
Danny Blanchflower, pick up on that. The idea being that if we do see this shock appear, that central bankers will be even more active in trying to prevent the consequences.
Well, I think they will be more active. I mean, there are, however, limitations on what they can do. I mean, the Boston Fed president today that talked about the concerted action could come. Central banks certainly stand prepared to act. I think the Bank of England made that absolutely clear today in its forecast. Its forecast says inflation's not going to hit the target. We've got to do more. The question is, can monetary policy on its own do enough? And what we saw in 2008 was concerted action amongst the fiscal authorities, and now the fiscal authorities are doing exactly the opposite. We've got the committee here in the US, we've got the UK government in austerity, the French government talking about austerity. It's probably not enough for monetary authorities to do everything. They can't do everything on their own, so I say I'm pretty fearful that the monetary authorities can't do everything. They can't do enough, and they can't act quickly enough.
Vlad Milev, it seems as though there's a battle between central bankers and politicians. The politicians enacting austerity measures, the central bankers coming in and saying, no, what you need is liquidity, and you need to figure out a way to keep interest rates low in order to stimulate the economy.
Well, I think that we have overall placed an entirely too much amount of faith in central banks. And I think that we've had QE1 and QE2, and we've had all kinds of inventive monetary policy measures at the ECB and the Bank of England. And at the end of the day, I'm not sure that we're much better off structurally than we were at the end of the Lehman crisis. So I think that, sure, politicians are going to be forced into austerity because that's the reality of the numbers. You're looking at debt to GDP levels that are not sustainable. The market's telling you so. You have to do that. Central banks, however, can only do this much about structural issues.
All right, we're going to continue the conversation. We've got more with Danny Blanchflower of Dartmouth College, more with Vlad Milev of Payden, and more with Kate Warne of Edward Jones. Fears of contagion hurting U.S. bank stocks. We're going to find out if it's possible to avoid volatility and still make some money. This is Taking Stock on Bloomberg. I'm Pimm Fox. All right, U.S. stocks today extend losses after Fitch Ratings Service says that Europe's debt crisis poses a serious risk for banks. Speaking with Danny Blanchflower, he's a professor of economics at Dartmouth College. Also with us, Vlad Milev, financial investment analyst at Payden, and Kate Warne, investment strategist at Edward Jones and Company. Danny Blanchflower, when does unemployment start to push politicians to stop austerity?
Well, that's a really interesting question. I think actually a place to look was in fact today in the UK, because unemployment numbers are pretty important, but it turns out in lots of countries there are thresholds. And a threshold in the UK was reached today where youth unemployment hit the 1 million mark. It's never been there before, and that caused great consternation in the UK. So this is this morning, hit the 1 million for the first time ever. I think in the UK anyway, unemployment has started to be on the rise again. So as that happens, and the government claims it's to do with the Eurozone and it's the weather and it's bank holidays, eventually governments have to own unemployment. In the US, we're seeing unemployment's coming down a little bit. We're seeing some degree of job creation, but I think this shock from the euro area represents a really significant downside risk. Unemployment really matters, and I think you're going to see that's going to affect people's voting behavior. They're going to express their dissatisfaction, particularly about fears of unemployment and low income. I'm a person who really believes that unemployment is a big deal.
Vlad Milev, come in on the topic of unemployment, because as Danny Blanchflower describes, youth aged between 16 and 24 in the United Kingdom, more than a fifth of them are out of work. And yet we
21%.
21, a little bit more than 21% reported today. And yet we don't necessarily see, as Danny described, that tipping point when it comes to other countries in Europe, even though you've got, what, 20% unemployment in Spain, you have unelected governments in Italy, unelected government in Greece. When does the electorate start speaking based on unemployment?
Well, I think we've had protests in quite a few different countries, and protests have taken different shapes. Obviously, Greece protests were the most violent and I think most obvious to anybody. But I think it's important to take a look at a couple of different factors. First, remember the Middle East and how youth unemployment there is significantly higher than even the numbers we're quoting, and that can show significant social pressure at some point or other. The second important thing is remember that it can also be done. Look at the cases with the Baltics, with Latvia, for example. It's a small economy, but it's a good microcosm of what happened. A huge credit bubble, a huge contraction as a result, but they've bounced back and they've essentially taken cuts across the board. They've all shared into the pain of the austerity, and they've now grown growing out of their situation before. So it can be done, and I think it's a matter of the politicians really crafting the message properly and saying this is something that we're going to have to go through together. Politicians.
Kate Warne, come in on the topic of politicians, if you can, and tell us about a November 23 deadline for the super committee. Any action, do you think, Kate?
No, we don't think that there's going to be a lot of action. We think they'll come in with a minimal plan that may not even be as much as the $1.5 trillion in cuts. And I think that's going to raise all of these same issues in the U.S. that we're seeing faced in Europe, where basically people are unhappy that governments are now pulling back on services rather than increasing services. And no surprise, that's going to be something that's leading to politicians not getting high approval ratings and probably governments falling more than what we've already seen. I think in terms of answering your other question, though, that there's still clearly more pain that governments are willing to tolerate before they really change direction, because they're trying to look longer term, and most people are looking very short term at what they see delivered right now.
Danny Blanchflower, I have the feeling you want a little bit more to talk about unemployment than politicians, particularly in Europe. Tell us more.
Well, I think I agree with the previous comments that were made. I thought the comment on Latvia was very interesting. But I think we're now at a different stage. The evidence in behavioral economics is when you're in a crisis and you're all pulling together, that's OK. The problem then comes when some people are doing OK and others are not, particularly when the young aren't doing well and others in the economy are doing well. So relative things matter. And the concern is, particularly in the UK, you saw last week, the salaries of CEOs went up 49% in the same week when 1 million young people are unemployed, 250,000 people
we've got to leave it there.
For at least a year.
I want to thank you very much, Danny Blanchflower, Dartmouth College, Vlad Milev from Payden, and Kate Warne from Edward Jones.